Michelle Mabry here, your retirement guru, is back again, and today we're going to talk about taxes and investing, specifically the effect that income taxes have on your after-tax returns over a period of years. So you have capital gains and qualified dividends are taxed at one rate, typically 15 to 20% at the federal level. And then you have ordinary income tax rates, and that's your interest and your dividends, annuity gains. And ordinary income tax just means whatever your tax bracket is, which could be 40% or more. So many of you have heard of asset allocation. That is how you best divide your investments across stocks, bonds, CDs, based on your particular financial situation. But many of you have not heard of asset location. That is equally important as asset allocation, if not more. Asset location means where do you put the stocks, where do you put the bonds. So there's three different types of accounts. You have your after-tax savings that you do, after-tax investing, and then there's pre-tax, tax-deferred accounts such as your 401k and IRA, and then there's tax-free accounts such as Roth accounts. So where you put your investments makes a difference over time. As an example, we have a client who had $3 million. She had 2.4 in a taxable account and 600,000 in her IRA. So if you look at the growth of that money over time, and this assumes a 50-50 portfolio of stocks and bonds, actively managed stock funds and bond funds. If you look at the $3 million over a 10-year period based on the historical performance, her net after-tax returns in the most inefficient tax way resulted in a net return of an average of 4.33. So her $3 million grew to a little over $4.5 million. However, if she had paid attention to asset location and was more tax efficient with the portfolio, it could have added almost 1% to her bottom line. And over 10 years, that's more than $275,000. So it's pretty impactful. Now, depending on your situation and what investments you have in what accounts, it's going to differ, of course, but you should talk to your financial advisor and make sure that they're paying attention to tax efficiency.